Can all kind of agree that the Social Security crediting strategy is something worth waiting for. Everyone out there will tell you, wait until your full retirement age at least, and if you can, wait a little bit longer because 8% guaranteed for the rest of your life is great. But you can still get that in an annuity. Should you get an annuity? Well, aren't they all bad? I mean, annuities have high fees, they're complicated, low liquidity, you can't get that much interest credit for it, right? Well, if you just look at something from all the negatives, of course, it's gonna look negative. In this video, I kind of want to go over how I think annuities may be beneficial and where they lack. Kind of do a pros and cons, both sides of the coin we can look at. That way you can make the decision whether or not you want to go further into an annuity or you want to just swear off the entire thing and just go into stocks and maybe bank accounts. All right, first, I think we need to familiarize ourselves with annuities. Annuities are basically like your Social Security. Put money in it for a certain amount of time, then when it's time, you turn it on and then you collect a lifetime of income. Now in actuality, they're a little bit more complicated than that, but that's the basis of why you'd want an annuity. It is a way to store money, let it grow, and then later on turn it into a stream of income. Now there are, granted, a ton of other things you can do with annuities, but for the bare basic and for the proper premises of this video, we're gonna focus on that. Now to tie in on more what we're focusing on, Social Security. Everybody gets one. When you're, of course, working in the United States, you have enough working credits, you can get Social Security. Now Social Security has a set time when you can turn it on. And of course, it's based on a formula that they have. Now, one of the benefits of Social Security and waiting is that, if you can see on this chart, you are penalized if you take it out too early. And then of course, rewarded if you wait till you are 70. Now, each one of these kind of credits, as we like to call them in the financial space, of waiting is about 8% a year from your FRA, your full retirement age, until the age of 70. On the flip side, if you take it out earlier, meaning earlier than your full retirement age, you will lose up to 30% if your full retirement age is 67 and you start at 62. That's a 30% penalty, or roughly 6% per year. The math isn't exactly 6%, but that's the decrease. If you were to wait, and the credit a little higher than 6% if you waited, but that's kind of the ballpark we're playing in. Now, what if I told you you could get 7% interest credit, kind of like how Social Security does it, guaranteed? You can, and that's in the private annuity business. I can't exactly tell you which company it is or whatever because that's not compliant, but I will let you know that there are products out there that give you anywhere between 6 and 8% guaranteed on your crediting account. Now that can be very complicated. Don't take this to the bank. Don't take this to the bank. And the thing is, you gotta kind of play with it. So because we can kind of attach it to Social Security, and we can all kind of agree that the Social Security crediting strategy is something worth waiting for. Everyone out there will tell you, wait until your full retirement age at least, and if you can, wait a little bit longer because 8% guaranteed for the rest of your life is great. But you can still get that in an annuity. A lot of times, it's pretty much the same amount. It's just our brain is so wrapped around annuities are bad that we don't give it a chance. So I hope I'm done talking. I'll get to my sides. I won't sit on this pedestal for much longer. Let's get into the pros and cons of the annuity. Number one con, fees. So annuities are pretty much infamous for having these huge fees. And the bad part about these fees is for the most part, they're invisible. We don't see the fees because if you were to look at a lot of the more common annuities, they have 0 fees. But you're like, but annuities have high fees. Yes, they are hidden. And I don't mean they're hidden because they don't want to tell them to you. They're hidden because of the way that the annuity kind of runs its business, its contract. It has a ton of options, which also are derivative stock options. And then they use bonds, they use interest rates and zero coupon bonds to create the kind of return that they require. And all of those functions of finance do take time and money, which in turn generates fees. Now, the good side, these fees are built in to what you can expect. What do I mean by that? If there's a zero floor in your annuity, meaning you cannot lose any money than the principal you put in, then those fees will not hurt your theoretical principal, your bottom line. While yes, your money is worth more because of the time value of money, they are letting you know from the get-go that you can't lose any of your money, but we're going to cap some of that upside. And that's part of their fee structure. We don't get to see it really, but do we really want to? Number two, it's complex. Kind of like what I was saying about the options, the bonds, and the all that fun financial stuff that the insurance company annuity contract goes through. They are, yes, very complex. When we strip it down to what we as consumers look at, they're much more simple. What do I mean by that? They are very simple. You have a point-to-point crediting method. The annuity can get anywhere between 0 to, 8-10% per year based on January 2nd of 2021 and January 2nd of 2022. Whatever it does, the future number minus the past number of that 1 year, if that's your crediting time period, that's what you get. You don't have to follow the market every day. Just get that. Also, if you know which one you're putting it into, meaning you actually get the annuity contract and you have your insurance person explain to you what you actually own, that's all it is. You're not flipping in and out of different stocks or buying and selling different kind of equities or trading any kind of options like the insurance company is. They simply have to provide you, the customer, with the guarantee that they provided you at the beginning of the year. Next one, following along this same level of complexity and fees, is the lower upside. And that's primarily because if you are investing in, let's say, you put your index credit on the S&P 500, what happens if the S&P 500 goes down? The insurance company or the annuity company has to eat that. Of course, then if the annuity goes up, they get to profit on your money after a certain amount. And in actuality, that's not really what happens. What happens is they probably buy contracts of options, call options, put options. They probably actually sell options or probably premium selling options and buying some kind of a protection by means of a swap. I'm going too far anyway into it. But as far as low upside potential, at least the low upside is presented to you, and in change, or on the pro side, in change of having that low upside, you have no downside. And especially with volatile times like now, no downside is pretty good, especially when you are guaranteed your principal. So basically, it's a riskless trade, provided that you can abide by all the other terms on that annuity contract. The next problem, number 4, is they're illiquid, meaning that you can't take it out. On that same line of thought, if you do take it out, you have to pay a penalty, surrender, right? There's high surrender fees. And this is built in because if you give them money, they have to set up all these complex financial transactions. And if you are to exit the strategy or exit that contract before all of these kind of financial transactions are allowed to play out, there's a cost associated. There's a cost associated with that entire function and the entire function of having this business being written by the insurance agent. Now, the insurance agent is going to get a chargeback, meaning that the insurance agent will lose all the commission that he or she gets by helping you with the annuity contract. But a lot of those operational and administrative processing that took place to put the annuity in place, those didn't go away. So what's the good thing then about this illiquidity? Well, of course, the good thing is it will make you think twice about getting out of that trade or getting out of the annuity because of those fees. Now, I know it's going to sound very counterintuitive. I myself love highly liquid financial tools. Like I trade options, I trade stock, and I trade things primarily based on how liquid they are, meaning that I can get in and out of the trade like that. But for an annuity, you are actually trying to let this thing play out. You want to be able to, let's say you purchase something at age 55, you want to wait until you're age 65 to execute. And here's something that rarely anybody talks about, and I'm going to stand right here in my sandbox and say, or soapbox, I don't really know what it's called. Anyway, we all tend to forget that with retirement, and an annuity is a retirement planning tool, you really only have one shot. What do I mean by that? You just have one chance to get your retirement right. You can't renege or reset or mulligan your retirement. Once you do it, it's already done. And annuities, Social Security, long-term care insurance, all of these things are very large components of retirement. And the income component is a very big one as well. So if you want your retirement to work out, have a great long stretching strategy, and then you have that strategy in place. If short-term things happen, you need to build your strategy so that you don't have to make short-term decisions based on things like emotion and very fleeting things, even though yes, things going around the world right now are not small or fleeting, but your retirement strategy should be in a place where you can kind of weather these types of actions in the short term, because you know in the long term the ramifications of what happens today won't have a huge impact on the length of time that you're in this annuity product or this retirement plan. Right back here, last thing I'm going to talk about is that there's no death benefit. If I die, all that money I gave to the insurance company to provide me with lifetime income is gone because my life is over. I'll be honest with you. Same thing with Social Security. Now that's not the pro I wanted to talk about, but many annuities nowadays do have things that will allow you to pass on your benefit. You could get a joint annuity. Now, joint annuities add another level of complexity because it factors in the two ages or the age of your joint annuitant. You could also get something that mimics kind of like a death benefit, where instead of having a higher payout, you take a lower payout in the assumption that if anything were to happen to you and your spouse or your beneficiaries need more money, then you could have that annuity value, whatever's left, be provided to your beneficiaries. Now, this is relatively new. Many of the annuity products nowadays have all kinds of functions and features that can be customized to how you want to have it. Now, you're going to have to talk to somebody most likely, or at least have a good idea of what you want this money to do, meaning that you can't just tell somebody, here, I got $1 million, make it work for me. You have to let them know how you want your retirement to look like, how you want your beneficiaries potentially money to pass on, how you want to be taken care of. If in the event you need help around the house, you need some kind of a custodian care or convalescent care or long-term care, what are you going to do during those times? And then the planner can help. This channel is not made to give you that kind of advice. It's made to give you kind of a resource of tools to allow you to understand what is actually out there and how things can be used, and to dispel some of these myths that like annuities are terrible and only bad people sell them. I'll be honest with you, bad people sell all kinds of stuff, but so do good people. And I personally do sell annuities. I don't advertise any of them on here. And if you don't want to buy any from me, I'm A-okay. Watch the channel, get all you can, make sure that your financial professional, whoever you're talking to, knows their product, and more importantly, knows what you want, because that's where the person, the human in this transaction makes the most sense, where the connection there. Because if there wasn't, then you could just watch my channel and then you could do it yourself. That can happen if you watch this channel and then get your insurance license, because you can't sell insurance products unless you have an insurance license, but you can definitely buy them. And you want to make sure that you get what's best for you. And long ending of a video. Now in this next video, I want to talk about Social Security and the pros and cons again of getting it early and waiting. So see you in that video. Have a great rest of the day. Bye now.